Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Market Reporter at Nasdaq. Joining me for this segment, we have Chuck Fuller, Portfolio Manager at Nasdaq Dorsey Wright, to discuss asset class and sector rankings as U.S. equities retain the top spot despite the pullback. Chuck, it's great to see you as always. Welcome back to Trade Talks. And I was actually surprised going through your notes here that we did retain the number one spot with U.S. equities.
Yeah, the last couple months, haven't been easy in the U.S. equity space. We've had, roughly 10% pullback. But yeah, our long-term rankings haven't really changed much. The U.S. equities remain at number one. And really we've seen enough of a correction over the short term that some of our shorter term indicators have gotten very oversold. There's one in particular that we look at, the percentage of stocks in the S&P 500 above their 50-day moving averages. And that just reversed up from below 10%, which historically is a really good sign for equities. It means that, forward returns going out a year are typically around 18%, so close to double what you usually get from the market. So yeah, it's been good from that side. We have seen, I would say, one of our longer term indicators start to get a little below where we like to see it. That's a percentage of stocks in the that are in a positive trend. That's fallen below 50%. It's currently at 44. Typically, bad things happen when that indicator is below 50, but not always. A lot of times the market, being the market, it likes to get, just below 50 and then, kind of reverse up from there. And my guess is that that's what we're going to see this time, given that some of these short-term indicators got so overdone earlier.
And in terms of sector rankings, which ones continue to stay at the top spot?
Yeah, really, we haven't seen a lot of change there. Still technology number one. Industrials are still at number two. I think that hasn't really changed in the last couple of months. I'd say the biggest change has been energy. Oil prices obviously have gone through the roof. Energy stocks have made a big push up because of that. And it's gone from number 6 to number 3 in our rankings. And then, other probably notable developments are that real estate and utilities are still ranked at the bottom, given where rates are, haven't spiked and whatnot.
How about international equities?
Yeah, so international still at number 2. They pulled back a little bit more over the last couple of months. Maybe about 1% or so more than the S&P 500. But the rankings, within international equities have stayed pretty stable as well. So we still have emerging Europe at number 1. Think about, places like Poland and Hungary and kind of all those Eastern European countries. They've really benefited from, I think, the Russian war, not being as bad as maybe it was, let's say, a year ago. And so they've rallied more than some other places in the world. But yeah, they've been at number 1 all year, remain at number 1 now. We have Latin America at number 2, and that's been declining a little bit. Actually, developed Europe's pretty close to taking that over. We're not quite there yet. But yeah, we've seen some huge returns from emerging Europe, so we're pretty happy about that.
How about fixed income? What's been happening with the 10-year over the past month has been interesting.
Yeah, I mean, the 10-year has just been relentless, right? I mean, it's really been relentless all year. We thought we were getting a reprieve from it. And then the last, 2 or 3 months, it's just been through the roof. Right now it's up around, 4.85% or so. I will say it's overbought, given, our indicators. So it's due for a pullback. Now that pullback might take you to maybe 4.3% or so, if it just kind of regresses back to the mean. We really have to see a move probably below 4% from these levels to see an actual change in the trend. But underneath the hood, there have been things that have been working, just obviously not like long duration treasuries. There's been really kind of minimal change in the rankings there, with high yield still number 1. Preferreds are at number 2. Those are both the best performing groups this year within fixed income. And like I said, there's long-term treasuries, they've been at the bottom of our rankings for months and obviously are still that way, given that they pulled back, probably about 7% over the last couple of months.
And finally, commodities. It seems to be everything's in the end a holding pattern this month.
It is, yeah. So commodities, they're still at number 3, and they, they're close to taking over the number 2 spot from international. Haven't quite gotten there yet. Obviously, the story there, as I alluded to before, is energy. But below energy in the rankings is agriculture, and that's maybe been a little bit more interesting of a story this year, because maybe not as many people know about what it's been doing. But there's been some crazy returns out of agriculture commodities this year, with things like orange juice is up almost 90%, and given bad weather in Florida and whatnot, and multiple other areas are up over 30% in that space as well. So that's been interesting to see.
All right, Chuck, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.